special guest who's joining us now on the show. We have Jonathan Garner, who's joining us from Morgan Stanley to talk more about emerging market scenario versus India. Jonathan, good morning. Thank you so much for your time. Even though you believe that India is your top pick in the EM space, you are generally a bit cautious about the emerging market pack, at least for the first half of this year. What is your hypothesis, and what are some of the areas which is giving you that kind of a thought process?
Yes, we really like India. It's our largest overweight. We're 150 basis points over benchmark for the Pan-Asia EM investor. So along with Japan, it's a key pick. But for emerging markets more generally, to answer your question, the dollar is firming somewhat. And we have had the view that the Fed wouldn't be cutting rates, in March, and now the consensus has moved towards that view. So we still have a very high cost of capital environment, and China is struggling, and China is the largest market within EM. So for the investors that we advise, it's really a question of picking your spots, and India is one of them.
So popular narrative was that there could be a rate cut in March or mid of this year by US, and other emerging markets could follow, Indonesia, India, to some of them. How much delay do you expect there, and where could it take the dollar index in your view, which got very oversold and now is in a rebound mode?
Yeah, so we've had a long-standing view that the first Fed cut would come in June, and now the consensus has moved towards our view, and then it would be in our expectation really quite slow to reduce rates, and that's because even though there is disinflation, the US economy is still powering along quite well. So for India, that's not such a problem, because the Indian economy, of course, is also doing very well. It's in a virtuous cycle of improving nominal growth, earnings growth, capital inflows. So the currency is far more resilient in the face of dollar strength than in the past. But that's not true of other emerging markets. So again, China probably needs the currency to weaken. A large index constituent like South Africa doesn't have the kind of balance of payments that India now enjoys. So we think that the Federal Reserve will be cutting rates only quite slowly in this environment.
Slow and steady, because you don't want to undo what you have achieved so far. So of course, the central banks will move very, very cautiously. But Jonathan, I wanted your take regarding what the narrative is regarding valuations in India, because they're not cheap by any metric. And what I wanted to understand from you is, what are the triggers lined up for the Indian markets? Because election is pretty much factored in, and earnings, a lot of players are saying that the peak is behind, because this earnings season as well, there were a bit more disappointments rather than positives.
Yeah, so that's a great question. So our Sensex target is 74,000 base case from Ridham and the team. There is a bull case target that's higher than that. I think it's around 86,000. But certainly, if you look at, say, a 1-year forward PE multiple for MSCI India, that's trading, probably around about 22 times 1-year forward PE, which is right at the upper end of the historical range. However, there's rarely been such a good earnings environment as we currently see in India. So, the upside is not as big as it was, 6 or 12 months ago. I think I've been on your show a few times. We've been pretty consistently bullish India. But remember, we actually expect sort of downside or zero returns for some other parts of emerging markets. So the relative preference is still absolutely there in India's favor.
Sorry, so are you saying we should expect only, let's say, mid-single digit kind of realistic return expectation from the Indian markets as well?
That's the base case. As I mentioned, the bull case is higher than that. I mean, do bear in mind that our base case is that the S&P 500 has downside. The S&P 500 base case view we have is 4,500, not 5,000. And of course, a lot of the gains in the S&P have come on the multiple side. In fact, probably more of the gains on multiple relative to earnings for the S&P than for India, where the earnings growth story is very strong. But you can't argue that that these markets that have done well are cheap, with the possible exception of Japan. Japan is a very strong story, and it trades only about 14.5 times 1-year forward PE.
Right, Jonathan. Also just in terms of a strategy for India, you said that you all have been bullish on India. You do like financials as well as domestic industrials. Anything specifically that you've added on that front, or you find even more attractive right now?
We also like consumer discretionary and property. We're restricted, unfortunately, in talking about individual financial stocks, but the names that we have in our focus list from India at the moment are DLF, Larsen and Toubro, Maruti Suzuki, and then the mega cap Reliance Industries. But on the financial side, I'm afraid I can't comment on detail on the stocks, except to say that the financials in India are perfectly capable of an earnings CAGR of 15 to 20% on a 3 to 5 year view. So they're fundamentally very attractive. That comes back to the story in India, which is rapid economic growth, urbanization, household formation, formalization of financial market activity in the context of lower and more stable nominal and real interest rates. That's extremely exciting for sectors like financials, but also for property, clearly.
For a moment, Jonathan, just out of curiosity, I want to go back to, outside of India, which is Japan. It's at a 30-year high. You're saying that it's a very strong story, and that too not available, very expensive. What could it do to flows into the region? Could it mean that incremental flows from global investors coming to emerging markets, a big chunk of that could be drawn towards places like Japan?
Japan is getting very large inflows, probably about 70 billion US dollars last year, very strong inflows currently. It's also exhibiting outperformance in terms of earnings growth, nominal GDP growth, and an improvement in return on equity. But I wouldn't see it as money from emerging markets being diverted towards Japan. It's really within the whole global investor universe, there's an upweighting of Japan. And I think there are global investors that are interested in India, and India's getting its share within the EM bucket as China is losing share. So it is quite remarkable that India's market cap within MSCI EM is gaining quite rapidly on China. It's not at all inconceivable that India could be a larger market than China within the EM universe within a 3 to 5 year horizon.
Jonathan, India has also been a very big beneficiary of flows, both domestic and overseas, on a 10-year basis because of the reform, superior growth, yes, you spoke about, but also the reform momentum triggered by the current leadership. And they are also now taking stock of it and talking about it. I'm sure this comes up in many of your conversations with your clients overseas as well. But we, at this juncture, 10 years into this government, what incremental work would the foreign investor community like to see in places like India? There is talk of new generation reforms, etc. Where would you see incremental work like to happen?
I think it's to a large degree more of the same. I mean, if you just sort of zoom in a little bit on recent developments, I think the fiscal announcements are really quite important. So maintaining fiscal discipline as the economy grows, targeting government infrastructure capex, enabling private capex, being open to foreign direct investment and portfolio flows, private equity flows. I don't think there's anything dramatic and new that's really needed. It's a mix that has succeeded from an investor perspective for a considerable time, and we've been overweight India for a considerable period of time.
Jonathan, I also wanted to get a feedback of what investors are thinking about India with respect to large cap versus mid caps. Are they getting a bit impatient about the underperformance that we have seen from the banking majors and the large caps? Because the mid caps and small caps has been a completely different story. Are they getting more gravitated towards the broader end of the market now?
Most of the investors that I talk to are not really involved in Indian mid and small caps. That may happen over time. So for them, the index is the MSCI India, and it is the larger cap stocks. It is encouraging to see. I mentioned some of our preferences just a while back, but some of the largest market cap stocks are performing well recently. And so I don't encounter any great pushback about lack of performance for India. And again, remember that it's relative performance that matters for most of our clients. So with the China market, unfortunately, having got off to quite a weak start to the year, again, people are perfectly happy with the India exposure they have in their portfolios.
Right, Jonathan, and just one last word in terms of the flows then you see. Do you expect an increased pace of flows coming in for the Indian equities now? And that continued flow that we've seen, do you think the pace is going to be increasing?
Well, clearly it is an election year. India's not unusual in that regard. There are important elections upcoming in South Korea, in Indonesia, and obviously in the United States. So that may lead to some volatility, and our colleagues, Ridham and the team, have written about that. But broadly speaking, I think it's, as I said, it's a steady as it goes environment, and India will get its share, probably more than its market weight share, as it were, within the EM flows that are coming in from global investors. That's certainly our recommendation, to put more money to work in India.
Jonathan, thank you so much for joining us with your thoughts as far as emerging market pack is concerned and how India is doing and how you're looking at the various parts of the market.